Hello and welcome back on another video on how to become pro-efficiency and improve our financial literacy. By looking at this sec here, okay, and understanding this basic financial statement, which after all they show you money, and you have four of them. The balance sheet that show what a company owns and what it owns at a fixed period of time. The cash flow that show the exchange of money between the company and the outside world. The income statement that show you how much money a company made and expend over a period of time as well, and the statement of the shareholders, which show change in the interest over a period of time. So the TLDR for the balance sheet is that it shows the company assets, liabilities, and shareholders' equity. And the income statement, the bottom line, show you the net increase or decrease in profit. So in other words, it tells you if a company made a profit or not. So then I look at the cash flow statement, okay, which it shows the company inflow and outflow of cash over a period of time. So while the income statement can tell you whether a company made profit, a cash flow statement can tell you whether a company generated cash. And it reuses all the information from the balance sheets, the income statement. The bottom line of this statement show the net increase and decrease of cash. And they're generally organized in three main areas, where each area review the cash flow from operating activities, investing, and financing. So the operating activities, what it does is to analyze the net income for the income statement, and it adjusts for any non-cash or any cash that was used or perceived from other operating assets and liabilities, something that they describe here, right? In it is operating assets, in it is operating activities, whether it's operating assets and operating liabilities. And to do this, it adjusts the total, the net income for any non-cash items, meaning items that affect the income statement, such as stock-based compensation, amortization, or depreciations, without any cash transactions. And it also adjusts the total cash that was used for, the total cash that was used, Jesus, sorry, and it adjusts for any cash that was used or received from other operating assets and liabilities. And to understand this a little bit more, okay, well, I look at the most common operating assets, such as accounts receivables, inventory, prepay expense, which expense that you have to pay in advance to enjoy that good or service, such as premium insurance like health or medical coverage, or auto, your vehicle, home, to protect your belonging in case of accidents or potential damage, life, to ensure you in the event, to ensure the your siblings, your family, or others in the event of the policyholder death. Liabilities, such as liabilities, such as or lawsuits, in the event of lawsuits, as well as disability that prevent you from working, okay, and long-term care such as home health care or nurse care. Another example on prepaid expenses, uh, the rent, marketing, office supplies, software licensing, maintenance contract, and keep looking at the most common operating assets. I also look at the intangible assets, such as patents, which exclusive rights to inventors so they can manufacture and distribute their invention over a period of time. For example, maglev, right? This electromagnetic, the electromagnetic stabilization and suspension system for ground vehicles issued in 1979, where this is the source of this comes from popularmechanics.com, their website, which is very, very interesting. Another example is the GPS issued in 1974, where the patent name is this navigation system using satellites with passing ranging techniques. The electronic device, or the iPhone, issued in 2007, as well as the CRISP, this gene editing, issued in 2014. Another intangible assets, such as trademarks, words, webs, designs, videos that uniquely identify this company from the rest. So, for example, Michael Burry and it is famous "Let's Get Ready to Rumble." Copyrights, so exclusive right to creators of original work to distribute and sell their invention, such as McDonald's, Twitter, Netflix, Spotify, and so on. You name it. Uh, Trade secrets, which is another intangible assets, confidential data that a company uh, receive to gain competitive advantage, such as uh, formula, process, or customer lists. Goodwill, the brand reputations and recognition, as well as the customer loyalty and the customer relationship, right? Another example of the operating assets, we have the investment in affiliates, very, very, very common on marketing, where this is a company that invests in another company to earn a return of the investment, as well as to gain some influence but not full control of that. It might be as well as take strategic advantage in the market. So you have here joint ventures. Okay, so a partnership between two or more companies to undertake a specific business activity, such as Crocs and Post Malone. Okay, um, what else? What else? Equity investment. A company purchase significant stake on another company stocks to gain some influence and raise its potential voice in the another's company decision, such as Berkshire Hathaway, led by Warren Buffett, this multinational conglomerate holding company. And a holding company means that a company that doesn't engage directly with business. In fact, the way how they engage is through stock purchase. Okay, you have Berkshire Hathaway that invests in a variety of industry like energy, uh, yeah, like energy. Uh, what else? What next? Yeah, like energy, real estate, and retail. SoftBank, this Japanese conglomerate, which primarily invests in technology companies such as WeWork, Uber, Airbnb. Alphabet, the parent company of Google, that invests again, and as well as several technology company, for example, Calico, which is very, very underrated. You barely hear about that, which is focused on home health and longevity. TPG, which is a global private equity firm that invests again in a variety of sectors like real estate, health, and retail. And then you also have is Blackstone, which is a multinational investment firms, again, that invest in another variety of sectors. Here, the most notable investment for them is the BUs, which is the competition for. It is the closest competitor to Khan Academy, this online platforms, this educational online platform. And then another example of the investment in affiliates is limited partnership, where now an investor can purchase a significant stake on the limited partnership, provide them control over, uh, provide them stocks control, as well as operation, uh, as well as operations, as well as partnered assets and operations and company operations. So you have to be very careful of this. LP, or this limited partnership, are mainly used for real estate or private equity. Okay, it's important to know that. And and mm, then I also look at the affiliates, which are investors that owns a significant amount of stock on another company, usually between 20 and 50%. Okay, and then I look at another operating assets. Okay, like money, uh, or cash and cash equivalents, such as money markets, right? Which the primary focus of money market is to invest in high risk, or is to invest in very short term debt, such as banks, or is certificate of deposit issued by banks with a short term maturity, uh, company company papers. I think they call that company paper. Exactly, commercial papers. Is commercial papers. Okay, so commercial papers is an unsecured short-term debt instruments issued by corporations. Okay, so these investment firms select which one of this company they want to buy, which one of these commercial paper they want to buy. Um, and then I also look at the the operating liabilities. Okay? And to make a quick recap of the operating assets, you have accounts receivable, inventory, prepaid expense, property, plant, and equipment, investment in affiliate, intangible assets, money market fund or cash and cash equivalents. And when it comes to other or operating liabilities, we have is accounts payable, which is amount of money that uh, another company owes you by service that you have rendered to them. Okay, so if I look at the example of that, you have salaries, rent, taxes. You got here is the operating activities. That's right. Operating liabilities. That's right. So you have is accounts payable. Okay. When I look at the accounts payable, at least example of the account payable. Okay. Okay, but the subtle difference between account payable and accrue expenses, okay, is that accounts payable is money that you owe to your vendors and suppliers, usually as short term within 30 to 60 days, and it can be, for example, raw materials. Okay, and it can be raw materials, office supplies, and service. And when it comes to accrue expense, okay, accrue expense are now more general. Okay, accounts according to chatgpt, right? According to chatgpt. So accounts payables is money that you own to your vendors and suppliers. So the subtle difference between a supplier and a vendor is that a supplier is needed for your business, whereas a vendor, no, it can improve that, but it's not crucial. Okay, all right, cool. Uh, so this is accounts payable. Okay, usually it's a short-term debt, 30 to 60 days. And a couple examples is that raw materials or office suppliers or service as well. For example, in the software field, in the software field for that. And what else? What else? What else? And like like the account or the accrue expense is now this our expense that a company incur for service that has been received but not yet paid. Okay, this is accrue expense for service or for uh, good or service that has been received but not paid, but not yet paid for. Okay, so this is the accrued expenses, right? This is the accrued expenses. All right. So this is the accrued expense. So yeah, this is accrued expenses. Mm-hmm. This is accrue expenses. Totally. So okay, this is accrue expense. Okay, so this is expense that a company incur for. Yeah, this is expense that a company incur but has not yet paid for. Obligations to pay. Exactly. Or obligations to pay for good and service that has been received. Exactly. So example of this are salaries, rent, taxes, utilities. Okay, but again, this is to look at a huge overview of that. Okay, about the accrued expense. Okay, so in other words, accrued expense are obligations that a company needs to pay. Sorry, obligations to pay for good or service that has been received, such as wage and salaries, rent, utility, taxes, right? That makes sense, a lot of sense. And then I look at the recurring earnings, I think is this, or defer earnings. In Spanish, this is ganancias diferidas. So in Spanish, accrue expense. Okay. In Spanish, accrue expense is gastos acumulados. And on English, okay, defer revenue, meaning ganancias diferidas. Okay, and deferred revenue is, well, is payment. Yeah, let me think here. I just want to think about this. So, accrue expense no is. I don't want to see the screen. Let me see if I can recall that. Deferred revenue. Okay. So deferred revenue is payment that a company uh, so payments that a company have to uh, okay. Okay. So payments receive in advance for good and service that has not been delivered or provided. In other words, it represents the revenue that has been collected but that has not yet been earned. So deferred revenue is recognized as a liability on the company balance sheet until the goods or services are delivered or provided. So deferred revenue is considered a liability because deferred revenue is considered a liability even though that you have collected payment, but you have to provide uh, the good and service. Yeah, but you have to provide, or your promise that you're going to provide the good and service is this. So, for example, subscription service like Netflix, Spotify, you have to pay for them. You have to pay them in advance for service that you're going to enjoy in the long run. Okay, but for the company perspective, this represents a liability because it's money that you have collected. This deferred revenue. Okay, so this deferred revenue for a company representing a liability because even though that you collect the money, you have to provide the good and service for a particular time or over a specific time. Okay. Well, they actually doesn't mention here anything about time. Okay. Exactly. They actually doesn't mention anything about that. So once the goods and service are provided, The deferred revenue is recognized as a revenue on the company income statement. So this deferred revenue at the beginning is considered. So this deferred revenue is considered at the beginning a liability for the company, even though that it collect the money, but the good or service has not been delivered. Okay, but for the good or service has not yet been delivered. Exactly. So the good or service has not. So the good or service has not yet been delivered. Okay. Yeah, yeah. So the good or service has not yet been delivered. That's what happened. So the good or service has not been yet delivered. hmm So deferred revenue, and after all, that's deferred revenue. Okay. So that's deferred revenue is a is an obligation that a company, even though that collect the money to provide the good and service until it is done. Once once yeah once that uh, so once the good or service once the good or service are provided, then you recognize that as a revenue on the company income statement. An example of deferred revenue may include subscription service, prepayment handling service, and gift card. So for each one of them, for each one of these example, okay, such as subscription service. So a company may offer subscription-based service such as software or streaming content and receive payment for several months or year in advance. The portion of the payment that relates to future period will be considered deferred revenue. Prepaid maintenance service. If a company provides maintenance service for its product and receive payment for several months or years in advance, the portion of the payment that related to the future periods will be considered deferred revenue. Gift card. If a company sells gift cards and receive payment for them, the value of the gift card has not yet been redeemed or collected or redeemed and will be considered deferred revenue. Deferred revenue is important to track and manage, and it represents a future obligation to deliver goods and service and can impact the company cash flow and financial statement. But in other words, this deferred or this deferred revenue is an obligation to pay. This deferred revenue are payments. So this deferred revenue are payments that a company made in advance. Okay. So deferred revenue are payments. Okay. So deferred revenue are payments that a company made in advance for good or service that has not yet been delivered. It's not that hard. It's not that hard to understand. Okay. An example of that is subscription service, gift cards, and prepaid maintenance service. Okay. So the TLDR of the deferred revenue is there are payments that a company receive in advance for good and service that has not been yet delivered. For good and service that has not yet been delivered. Okay. For good or service that has not yet been delivered. So, for example, well, subscription service like Netflix, Spotify, gift cards, and prepaid maintenance service. So, I just want to look at an example of this, right? Your new chat, please. Software sales, maintenance contract, event tickets. Event tickets. Interesting. Event tickets. Deposit. When a customer makes a deposit for a product or service, the company may recognize the revenue when the product or service is delivered. This is a deposit. An event ticket. If a company sells ticket to an event, mhm. If a company sells ticket to an event, they may collect payment before the event takes place, but recognize the revenue when the event occurs. Exactly, event tickets. Okay, so gift cards, event tickets. Interesting. Okay, gift cards, event tickets, subscription service. This is an example of deferred revenue. Payments that a company collect in advance for good and service for good and service that has not been for good and service that has not yet been delivered. Interesting. Okay. Okay. So what's next? Right. So what's next? What's next here? Um, mhm, mhm, mhm. Doo-doo-doo. Next for operations. Okay. We got operating liabilities. Exactly. So far I have saw the three most common operating liabilities: accounts payable, money that a company owns to the suppliers and vendors. The subtle difference between them is that suppliers are needed for your company operations, whereas vendors, they can improve that, but they're not critical. Uh, Usually, this represents short term, such as 30 or 60 days. An example are raw materials, office supplies, service. Then I look at accrue expense, which now this is expense that a company incur for good or service that has not been for good or service that has been for good or service that has not been for good or service that has been delivered. Accrue expense, really? Okay. There are expenses that a company incur for good or service that has, or there are obligations. I prefer to mention that. So there are obligations. The accrue expense. So there are obligations. Okay. Okay. So there are obligations to pay. Mhm. So there are obligations to pay. Okay. So there are obligations to pay. Jesus, accrue expense. Okay, obligations to pay. Mhm. Obligations to pay for good or service. Mhm. So obligations to pay for good or service. Obligations to pay. Exactly. So accrue expense are obligations to pay for good or service that has not been received. Okay. Man, why take so long? It's like, what? Did I lose my shit? Okay. So this is accrue expense. Okay, they are obligations. So yeah, that represents obligations to pay for good or service that has been received. This accrue expense. Okay, I already received this, but I need to pay that in the future. So, for example, salary and wage, rent, utility bills, taxes, and when it comes to accrue or defer revenue, is they are obligate they are payments that was collected in advance for good or service that has not yet been received, such as subscription service, event tickets, gift cards. All right. So with that, that'll be all for this video. Take care. Bye bye.